Alternative investments are defined as non-correlated assets, meaning that their performance doesn't follow that of a more traditional asset classes such as stocks and bonds. They offer investors risk-return profiles that are different from traditional long-only equity or fixed income investments. Today, individual investors can gain greater access to alternatives through liquid options such as open-end mutual funds, ETFs, and closed-end funds that have no or low barriers to investing that provide daily liquidity. The characteristics of alternative investments are as follows. The liquidity of alternative investments depends on the individual investment. Some alternative mutual funds provide daily access to cash, limited partnerships, but on the other hand, can have restrictions from 30 days to longer than 10 years. The fees for alternative investment vary and depend on the fund structure. Partnerships typically entail a management and performance fees. Mutual funds charge a management fee but no performance fee. Why is it beneficial to include them in a portfolio? Market volatility has the potential to erode a portfolio's value. Commonly cited objectives include the following. To mitigate the effects of stock market volatility, investors can decrease their reliance on traditional market performance and potentially lessen their overall portfolio risk. It should be noted that diversification strategies do not ensure returns or protect against losses in declining markets. Secondly, to lower correlation to traditional stocks and bonds markets. Returns of alternative investments show low correlations to traditional asset classes like stocks and bonds, and therefore by adding them to a portfolio, one can reduce volatility without sacrificing a part of their return, the free lunch. Lastly, to hedge against a portfolio against inflation. As an example, commodities have historically demonstrated among the highest correlation to the consumer price index versus other asset classes. Alternative investments have diversification benefits as different assets are affected differently through the year due to economic and market factors, thereby minimizing systematic risk. We will now introduce 4 types of alternative investments.
Catastrophe bonds, also known as cat bonds, are a type of insurance-linked securities that allows insurance agents to transfer risk to bond investors. The idea of securitizing catastrophe risk came after Hurricane Andrew in Florida in 1992. This catastrophic event caused 7 insurance companies to go bankrupt, and the first cat bond was introduced in 1994 by a German insurance company. The purpose of cat bond is to reduce the greatest risk associated with the insurance catastrophic events. For the issuer, typically government or insurance companies, cat bonds act as a financial protection in case of major natural disaster. For the investor, purchasing cat bond is attractive because they may receive high returns for their investment independent to the stock market. The key difference of cat bonds and corporate bond is that cat bonds have multiple triggers, and the triggers depend on the occurrence of the catastrophic events. Cat bond and ILS market have grew rapidly since its creation, and in 2017, the issuance of cat bond reached the record of $13.3 billion. Cat bonds are attracting investment institutions by offering true diversification benefits.
A cryptocurrency is a virtual currency created by a computer program. It uses cryptography to secure the transactions and control the creation of new units of the currency. The first cryptocurrency to become publicly accepted was Bitcoin. It also introduced the concept of the decentralized public ledger known as the blockchain. Because of the revolutionary technology, other cryptocurrencies have been developed. These are collectively known as altcoins. Volatility. Cryptocurrency prices tend to be very volatile. These are still very new compared to fiat currencies. There is still a lack of sufficient knowledge. Security and anonymity. Cryptocurrencies use wallets, which are computer software that stores addresses for receiving new units of the currencies and private keys for approving transactions. The design of the blockchain that cryptocurrencies use ensures that the identity of users are protected. Decentralized. Many cryptocurrencies are decentralized and are not owned or controlled by any organization or government. Mining. Mining is a process where the transactions in a cryptocurrency are committed to the blockchain and new units of the currency are created. Most cryptocurrencies use a proof-of-work system for mining.
Collectibles are items that see fluctuation in their rarity and popular demand. This means they're not stocks, bonds, real estate, or cash, but are generally tangible objects. Collectibles fall in many different categories that each have their own individualities in regards to financial risk, demand, supply, and yield. The most commonly traded collectibles are stamps, comic books, coins, classic cars, wine, fine art, and jewelry. How does it work? Today, many investors are devoting a corner of their portfolio to collectibles. For these buyers, such items aren't just an edge against the shocks of the larger market, reasons being that the collectibles are the purest form of market supply and demand. Collectibles are not affected by the usual market cycle. They are usually long-term investments that could bring high yields. On the negative side, collectibles are part of the low liquid market, and to access potentially high yield requires high investments. Additionally, there is less information available in comparison to the stock market. Agricultural commodities are basic goods such as staple crops and livestock produced on farms and plantations. The production of these soft commodities provide opportunities for portfolio diversification. These commodities have large price fluctuations that are based on a large number of macro-environmental factors. Agricultural commodities do not provide dividends and can be comparable to bonds in terms of risk due to inelastic demand. They are generally classified as soft commodities that are grown rather than mined. They include dairy goods, grains, rice, coffee, and livestock. Future contracts are the most common way to trade agricultural commodities, helping producers to secure the future selling prices of their harvest and help buyers to secure buying prices of raw materials. A number of factors in the future will put agricultural commodities in the spotlight. World population is expected to reach 9 billion people in 2050, and the demand for it is expected to follow the same trend. Also, climate change poses a future risk on crop yields, creating an uncertainty in the market.
In conclusion, financial service firms have recommended allocation models for clients with alternatives accounting for up to 20% of a portfolio. Of course, every investor is different and should choose alternatives that align with their distinctive goals, holding period, and tolerance for risk.